Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty, and I'm doing our weekly housing market update. Lots going on. I'm going to jump right in here on my screen and start sharing this with you, and we'll jump right into it. So, first bit of news that's happened is Bill Pulte over at Fannie and Freddie says GSEs will accept Vantage Score 4.0 immediately. So, this will be basically, and I did another separate video I'm going to be putting out with our modern home lending preferred lender on this, the owner of the company, Evan Einhorn, and he's going to get into some of this and some other real estate and mortgage news with some tips and tricks there. But basically, this is another kind of competitor model with Fannie and Freddie to the FICO scores. Now, it may take a while for this to kind of get going and for the investors on the loans to, get into it. But as it goes along, it'll be a good competitor to the original, FICO model. And what the theory is going to be on this is number one, it should end up because of the competition there and the way they're going to be scoring it and everything is you may see some better fees and in turn some better rates. So that's good news. Also, nothing necessarily new because a lot of lenders are already doing this if you know where to get them. But they're going to be also including in there where you can use, let's say, the last 12 months of rental history, on time rental payments as another trade line if you needed to versus just credit cards or other trade lines. So, and just another way to make it easier for especially first time home buyers or buyers to qualify to get through the Fannie and Freddie model with this new Vantage scoring. So, that's good news. It's always good to have competition, right? So, there's that. And then the next bit of news is besides the rental scoring there is Trump again calls for Fed Powell to resign immediately. Now, Powell's big thing is I'm not going to lower rates because of the tariffs. Otherwise, I would have probably lowered it already. Most people in the market already had priced in a couple of rate cuts for the whole year anyway under Powell's ideas and the current Fed policy. So, nothing extraordinary there. And I'll get into what next month looks like at their next meeting. But he's calling for his resignation because he wants lower rates. But also, there was, let me see if I can share this with you really quick. We're not going to get into this too in depth, but I'm just going to pull this straight off of Twitter here. This is straight from Bill Pulte, but basically, he posted this office and management and budget wants, basically they're looking at, and Congress is going to be looking at, and some hearings coming up. Most likely that they want him to resign because of I talked about this last week, the renovations on the DC Fed building and some things that they felt like he wasn't exactly truthful on and was way overspending on the original projections and so on. So without getting too far into that, that's kind of the gist of that. There were some rumors floating around yesterday that Powell had resigned over on the internet and social media sites and stuff. As far as we know, keep checking because I'm hoping he gets out of there. Look, Powell's an attorney; he's not an economist, and the reason why we have besides government spending over the last few years, which of course, too many dollars chase a few too goods gives you inflation. The reason why and that trickled into the housing market. The reason why we have that in a big way is because he raised rates too late. That's why he's known as, you've heard of Too Tall Jones, maybe for some of the older folk. Well, now you have too late Powell because he's always too late. It caused a lot of inflation out there, not just for the housing market, but for vehicles and all kinds of things in different industries and food and everything else. So they kept saying, remember a couple of 2-3 years back, oh, this inflation is just going to be transitory. Well, it wasn't in transitory, like a lot of people tried to get out and tell them, but they feel like Powell is too late and he's being political, and now he's got these other possible congressional and legal issues to deal with. So the hope for many, even in Congress, on both sides of the aisle, because they want him to lower rates, is the fact that he's got these other legal matters, and hasn't really done a very good job in their minds of managing, the Fed in general, not just with rates, which, again, plays hand in hand with the inflation and stuff that's been going on, but also with these other issues with mismanagement of funds in their mind, allegedly, and so on. So we'll see how that all plays out. He certainly has a ton of pressure on him. Um, with the president and Congress coming down on him, and Bill Pulte. So we'll see what ends up happening there. Next on the docket is, we see, is a surge in delisting. Is this good news for buyers? Well, obviously, the more listings we have, it gives buyers more options. It also, maybe, helps with pricing, obviously, too. But remember, we got to look at this as, are we talking about new home sales, because that's really the fresh new market, or is it resale that we're talking about when we talk about inventory? Okay, so keep that in mind, because really new product or new supply is really new builds. Okay, because 75% or so at any given time of home sellers in the resale market are also going to be buyers. Okay, so, just to list out some of these marketing trends here, and what's going on. Summary here for the greater Phoenix area. New construction is struggling with lower transaction volume, potentially leading builders to slow down new projects. Okay, a lot of that's dealing with the fact that they're giving all these incentives right now. Right now, you can get them. I know the affordability is still an issue, but you can get some amazing, for today's market, amazing prices, but more importantly, amazing lower incentives on your closing costs, your mortgage rate buy downs and stuff. And those mortgage rate buy downs that they're offering are fixed. They're doing, basically 0% down, or just pay your earnest deposit of 500, maybe $1,000 to get into a property on a lot of these builders right now. So, even though we were kind of, had a little bit of a trend up there in a new home market for a little while, we're starting to see declines, across the board, but especially in the Sun Belt and the greater Phoenix area. So resale market shows a slight year over year growth, 0.6% here in the greater Phoenix area. We're pricing year over year, but monthly declines, for the same month last year. Overall, depending on which index you look at, we're in some spots we're showing a 2% decline in overall pricing, for sales. So the luxury market, Scottsdale is actually up 4.3%, a little bit more stable, while entry level markets like Avondale are down about 5.3%. So like I say, it's kind of all over the board, and they face steeper price declines. Now, here's a big piece of the puzzle right here. Rental inventory surge. Active rental listings, uh, are up 19%, 5,915 from last year. Apartments up 30% as far as volume and inventory. Single family homes, for rentals are up 14%. So there's a little bit more options again for those renters out there. But for landlords, it creates a little bit of a pricing, mix up for you there, and maybe, being a little bit more competitive on pricing right now. So Phoenix, the Phoenix City, and a lot of this has to do with, some of the projects that we had going on. We had a surge in multifamily homes. A lot of people during the pandemic went out and they bought a lot of properties to rent out and that sort of thing. A lot of those projects, though, are seeing, the end result, that's been declining for a while. A huge drop off there, in construction, and also, as far as, those opportunities there. So Phoenix sees, a 34% increase in apartment listings as owners shift unsold properties to rentals due to weak sales. So can't sell the property, I'll rent it out and still move on, in a lot of these cases. Okay. Which is another way to do it. Okay. You could also, there's a lot of other ways you could do that too. You could do bridge loans, you could do all kinds of different things. and I kind of spell some of those out in the other video I was talking about with Evan Einhorn over at Modern Home Lending. But in any case, mortgage application, here's a big story right here because this tells us looking forward. Now, keep in mind, a lot of this is also people, because we did see an increase in listings, nothing crazy, into kind of more of a balanced market, really, for the number of volume that we have. But we have a lot of these sellers are also getting pre-approved for home loans too. So there is a portion of that in these numbers, but mortgage applications are up for 22 weeks, which is, that's great. Looking forward 30 to 90 days. Again, some of this has to deal with people actually selling their properties too. With 9 weeks of double digit growth, despite rates at, right around 6.7 or so. Right now, we're kind of hovering right there. So, but that gives us forward-looking data, looking out 30 to 90 days where we might see some more closings than we thought might be happening, depending on how the sellers do there and, on their sales and stuff too. So that could be a big component of that. So we'll keep an eye on that. To really make those numbers really, really mean something in a huge way, we would need to see, double digit growth for a sustained period of time for months. When will we see that? Probably, as we've seen when rates drop below like that 6.4 level, we see another surge, but we just don't stay there long enough. But if we were at 6.4 to six, even, to six, for a sustained period of time on interest rate, the average interest rate across the board, we would see, huge growth there. We know that because we've been there, and every time we do, those numbers tick up quickly. So the Federal Reserve rate cut for July for their next meeting, probably, if Powell's still in there, if he doesn't resign with all the pressure, we'll see how that goes with the shadow Fed. There's some names thrown in there like Kevin Warsh and some others, but Christopher Wallen. There's a lot of names being thrown out there. Even Scott Bessent, who's now Treasury Secretary, we'll see, has been thrown out there. Again, these are all just speculations, rumors. We'll see how it all goes, but that shadow Fed with basically whoever it is that the president picks will then be talking about what they'll be doing, and the bond market reacts to things that are said and done in government. We know that through, whether they're spending too much money or saying things that they're going to be doing, and we'll see the bond market react to that. And the bond market is certainly gotten a lot smarter on those sorts of things. We've seen, our growth take off right now. True inflation. It's a more of a now metric, and this is huge. Before we get into these other numbers, yeah, because it'll kind of tie in with this. But true-flation, if you go out and look at true-flation right now, I think today it was 1.68. Yesterday it was 1.66. That's more of a now inflation rate because the data that we see put out for like your CPI, your PCE, and what the Fed tracks with that PCE could be, it's always looking. Fed has always been looking in the rearview mirror. Trueflation, another metric data source out there that you could look at, uh, is looking at where is the inflation rate right now, not looking backwards. A big part of measurement of inflation is shelter costs. Well, shelter costs, how do they measure that? Basically, without getting into it, I've gotten into it before, but they measure it through rents. Believe it or not, and if they took the measurements like they used to, it could even be more accurate, I think. But in any case, that's how they do it, and it's kind of a backward-looking model where they look at rents. Well, you know how rents can be, right? Rents could a year ago on a lease could be much different than they are, a year forward or now from a year ago. So, like we just said, we, have seen a flattening in rental pricing. So, and a decrease in many areas of the country. So that makes up, about, 36, 37% or so of the entire inflation model, that shelter cost. So when rather than being proactive, again, I feel like the Fed should be at least, if even if they're like worried about tariffs, which is the dog that hasn't barked, with inflation going down and our surpluses coming in from tariffs so far of like what is it, in excess of 300 billion, and they're expecting it to be, what is it, at least 600 billion by the end of the year. Um, that's a part of that growth that they keep talking about. When they do dynamic scoring, CBO puts out this, well, they don't put in the dynamic scoring of what growth could be. And they're figuring with growth, with manufacturing coming back in, manufacturing ticking back up, job growth, all those sorts of things, and then these tariffs coming in, those are all growth or surpluses that could be taken into account that they're not really scoring in. So from that standpoint, they're looking at GDP of being like 3 to 3.5% are their projections right now, with the models that they're putting in with the tax cuts and the BBB bill that just went through, and the regulation cuts and the lower energy costs and the manufacturing growth that's been priced in, and $15 trillion so far, or more in investments. All those things have to be into play, and a lot of people just use a lot lesser growth models. It's kind of a lazier way of looking at it, really. But in any case, that's all something to think about. But the right now, with the way too slow is going, too slow, Powell. No Federal Reserve rate cut expected in July due to strong job growth of 147 jobs added in the last jobs report that comes out every month, though private sector is weaker. So a lot of these were still, excuse me, government jobs. There was some seasonal stuff with teachers kind of thrown in there. So without digging into that any further, that was kind of a good strong number. Again, the Fed wants to see weaker, and with their current model, with Powell's current model, too slow, antiquated Powell wants to, see a unemployment rate more of like 4.5, where before, a couple of years back, he was saying, "Well, we stay in line with where we are in inflation right now," but they're not. So, I mean, they should be in a neutral policy of at least three if they want to see, okay, let's do the wait and see what happens with tariffs, and that's the dog that won't bark. One other thing I'll throw out there is, in the first Trump term, the tariffs, although may have been a little different, we didn't see any inflation then. We had huge growth back then. People were making more money. The dollar was going further. And if you want to just say tariffs always cause inflation, well, just to name one country, although a lot of countries have tariffs, China, who probably what the biggest one of the biggest, if not the biggest manufacturer out there, right? I don't think anybody would dispute that. They don't have hyperinflation. Matter of fact, right now they kind of have a deflationary effect going on. So anyway, if you were just to say tariffs always do this, well, they're not. They're not there. So any case, we'll know more on that, and then once we get past the August 1st deadline on that. And really keep in mind too, there's 18 countries that make up about 95% of all of the growth. The two, with all the tariff stuff and trade, that we're really honed in on. So the two biggies that come in, you could say others. There's some deals being put together with China and UK and all that already that they've talked about. But the two to watch, I think, would be Japan and India. Watch that. And after we get past this August 1st date, um, that will really tell the tale on where things are headed. And that's what Too Late's waiting for. So after that, he kind of will or won't have an excuse anymore. Okay. And we'll see who had the right model there. Um, Redfin reports a national decline in listings. We see 1% year over year, and stable mortgage rates. When this was taken under their scoring at 6.6%, that was a few days ago, lowest since April of this year. So that's a some of that is also seasonal. Keep in mind, in the summer, a lot of things slow down, especially here in the Phoenix area. It's so hot. So seasonal, for if you look at a seasonal chart for housing sales, you'll see it kind of go like this, and it's the same every year pretty much. And for springtime, obviously that's the biggest season pretty much anywhere across the country. So obviously your retirement communities may be a little different with your winter visitors. That may be the reverse, but there's that. So um, some of the buyer seller implications here, buyers opportunities in new constructions due to decline in transaction, potential builder incentives, and entry level markets offer lower prices. A lot of people are saying what builders actually, a lot of builders are actually starting to do this now, is they should build smaller homes, kind of like your more historically speaking, entry level homes. A lot of them are doing that now, or starting to do that. Obviously these projects, take, 2, 3 years in the making, and then they still have to sell them. But that's something else, smaller footprint. Back in the day, it used to be, very small, maybe a 900 square foot home, 2, 3 bedroom, maybe 1.5 bath. That would be your entry level home. So, some people are saying that that's one way of fighting the affordability issue in the entry level market. So sellers facing challenges with declining prices or slowing leveling off in certain areas, depending on what part of the country, especially in entry level segments, and increased rental competition. So I always say too, with the rental versus buying, if you're going to be in a place 1 or 2 years, obviously you might want to rent, if you're not going to keep that property long term. But if you're going to, once you start getting into, traditionally at least 3, but 4 or 5 years or more, you know, uh, you're going to get the benefit out of it by gaining that equity over time. And then, you're also dealing with your fixed price and buying that, mortgage down and all those sorts of things. And, Albert Einstein, compound interest is the eighth wonder of the world, right? And that's what you kind of get when you buy a house, besides the freedom and a lifestyle, which is a whole nother part of that. So, let's see, market is shifting to more of a buyer's market in many areas of the country and around the valley, with only Fountain Hills and Paradise Valley remaining seller markets. So, with that, let me share this with you. So let me get this out of here. Okay. Um, so right now, we were in the greater Phoenix area. We're at the 79 cumulative days on market, with a 3.87 month supply. Now, what does that mean? So typically, right now in today's world, I think more of 3 to 4 month supply is kind of your balance range. Okay. Anything under that would be more of a seller's market. Anything over that would be definitely more of a buyer's market. And some of this obviously deals in seasonal stuff. So again, a lot of it can differ from different parts of the valley, your community. So if you want more information about what's going on in your subdivision, your zip code, let us know. The absorption rate, and this month's supply, that basically means if nothing else came on the market, that's how long it would probably take to sell all the properties out there right now. That's what's averaging out. So absorption rate, how quickly they're being absorbed by percentage, that's 25.87, which is a little bit lower. Again, time of year also plays a role besides the affordability issue. Average list price 729, average sales price is 596, and your average list to sales price ratio right now is 97 and some change, 97% and some change. Usually we like to see that just above 98% is kind of normal for the greater Phoenix area. This here will tell the tale a little bit more for you. Active listings have dropped off a little bit. That number was a little bit higher. It was up near about 28,000 just recently, um, and over the last week or two. So we see negative 2.8% on new listings, okay, or active listings. New listings is actually down 9.7% overall. And then we have pending is negative 3.8%. So we have a little less, in the buyer pool. A big portion of that, about we have about 25% less first time home buyers right now in the market. So again, if the rates dropped, let's say, just to use round numbers, um, 100 basis points or 1%. Okay. That, and again, you can get lower rates now. There are options out there, but if they dropped across the country, you would have on average about 5 million more potential buyers that could come into the market, is how the history works and tells us. So if you had a 100 basis point drop, 5 million more people could potentially enter the market to buy across the country. Okay. Closed units are actually up 5%. Okay. So the actually closings are up. So these are the price ranges right now where we see the highest percentages. Obviously, in that 400 to $600,000 range makes sense, with the medium home value being right in there in the mid 400s in the greater Phoenix area. So we can kind of see that this first up to about six, seven, 800,000 is kind of where the majority of the homes are. Not too great of numbers as usual in the we see these numbers negative all the way down here, um, as far as the percentage changes go. So that gives you all of that inventory. Now, right now, um, the Cromford Market Index tells us we're in a buyer's market because the index is below 90. If it's below 90 is a buyer's market, 100 being completely balanced, 90 to 110 is balance range, over 110 is a seller's market. And this plays in with what the supply and demand is. So if these two numbers are the same, this number would be completely balanced at 100. Your supply right now isn't super elevated, okay? Um, and it's been dropping a little bit, so it's at 105, and then demand is a little bit lower than we like to see at 76. So right now we're in overall, again, every area is a little different. Real estate's very local and hyper local, but right now we're in a buyer's market. Slight advantage to buyer. So we run on this 10-year treasury as far as mortgage rates are concerned, as far as you know anything basically to deal with what's going on in our lives as far as credit's concerned. Okay, let's just put it basically that way. And this number here at 4.3 um, traditionally should be no higher than the split between the 30-year mortgage rate, and this number should be no more than 2 points higher. So, in other words, right now we should see 6.3 or lower if the spreads were historically normal. Although the spreads have been getting better overall, trending down over the last year and a half, right now we're at a 30-year fixed on a conventional rate at 6.7. 15-year is a little bit lower. There's your jumbo number at 6.8. And at 30-year FHA is a much lower number. But remember, a lot of people in this conventional range can also get rid of their mortgage insurance, which you're not doing on an FHA loan anymore. You used to be able to, but you can't anymore. VA is at 6.3. So there's a quick look at that. One other, or a couple other indicators too, that I jotted down for you is touring activity right now is up 32% as far as foot traffic. Okay. But buyers are being very picky. Okay. And, but it's up across the country 32% year over year. Okay. So, and the Google searches for homes for sale is actually the highest in a year as of July 2nd. So those are just some other possible indicators to show us where things are headed. Again, those mortgage application numbers are up. That tells us, there are people out there seeking to buy and make a move. Okay. The contract ratios, this gives us a really good idea on where things stand as far as right now, what's active and what's under contract. Okay, so they call this the contract ratio heat map. And right now, the only hot areas are Tullison at the moment, and this small area over here in Scottsdale. So everything else is basically cold to balance or warm. Okay, but you can see here, like in Tullison, you've got 90 active and 55 under contract. So that's a hot area on the index. It's a contract ratio of 61, which is in that 60 to 80 range on the map. So on the indicator over here. So anyway, um, that's really all I have for you this week. And if you have any questions at all, feel free to reach out on anything real estate or mortgage related. We'd love to be able to help you out on that. One other quick stat. Oh no, I already gave you that. Never mind. Any other questions for us? Feel free to reach out anytime. We're here to help, and we'll talk to you next time. Thanks.